Hello again, this is Michael O'Leary from By the Book Taxes with the next installment in my video blog series on tax issues. Today we're going to talk about a topic that strikes fear in the hearts of most taxpayers. The IRS refers to them as examinations. Taxpayers know them as audits. So I'm going to give you an introduction to this topic today and explain who gets audited, why they get audited, and how they get audited. Okay. The purpose of an IRS examination or audit is to ensure that the tax return filed by the taxpayer is substantially correct. That doesn't mean 99.99% every nickel is in the right place. It's closer to, I wouldn't say the 80-20 rule. How about the 95-5 rule? The return is substantially correct. The IRS is typically looking to see if the taxpayer had unreported income, especially if they're self-employed. Are they getting paid in cash and the cash is going into their pocket? That they can substantiate or show documentary proof for the business expenses they were deducting, and if they have dependents on the return and are getting tax credits for those dependents, are they legally able to claim those dependents on the tax return? Okay, here are some statistics. Overall, generally speaking, it is very unlikely for the average taxpayer to get audited in any given year. The last tax year they have statistics for is 2018, 900,000 audits, just under a million, out of 150 million individual and corporate tax returns filed. A little bit over 1/2 of 1%, or basically 1 out of every 200, essentially. Tax returns got audited, and that's 1040s, partnership returns, corporate returns, estates and trusts, everything. Here on the screen, toward the bottom left, you could see the income rates, the audit rates by income level and return type. The bottom line is, the more income you have, the more likely it is you could get audited. Or if you're self-employed, the more assets your business has, the more likely you are to get audited. How do audits work? Okay, 2 ways. By correspondence, which means they send you a letter and they tell you one of 2 things. Either what you reported on your tax return doesn't match what was reported to us by your employer, by banks, by investment companies, the mortgage company, etc. Or specifically, if you're self-employed, they look at some of the expenses on the return and they want to see some substantiation for that. 3 out of every 4 audits are done by letter. 25%, 1 out of every 4, are done in person. Now, this is pre-COVID, where an IRS agent may come to your place of business, or they may have you or your representative go to the local IRS office. How does the IRS decide which return to audit? They have I call it a matrix. It's really a scoring system. So they run every return through the scoring system, and each return gets scored. The higher the score, the more likely it is that a taxpayer has unreported income, questionable deductions, or credits they may not qualify for. They may also be doing audits of other people or entities that in some shape or form are related to you or your business that can pull you into their net. Also, they get a lot of referrals from third parties, ex-wives, former business partners, disgruntled people, whistleblowers, etc., that can tip them off that you might not be on the up and up. As I mentioned before, document matching. So every year, the IRS is getting income documents reported to them for you. W-2s, interest, dividends, all K-1s, all kinds of stuff, 1099s. And they compare that to what you put on your tax return. If there's a difference, you're going to get a letter. Another reason is criminal investigations, believe it or not. They may do a criminal investigation and realize there's unreported income, and the criminal also turns into a civil investigation. If you're being audited, if you owe the IRS money, if you're getting scary collection letters, please give me a call. I can help. And we will continue to delve into audits over the next couple of weeks.